Okay, it's 10 a.m. Let's get started. Good morning, everyone. Welcome to Strategic Financing for Growth and Contracts webinar presented by Mr. Edgar Darrell from Gen West Capital. Today's session will explore how to navigate alternative private market when the traditional banking institutions is not an answer for you. My name is Jeannie Yang, and I'm a business and loan counselor at PACE. Thank you all for joining us today. This webinar is brought to you in partnership with the City of LA Economic and Workforce Development Department, EWDD, and BusinessSource, Pico-Union Westlake Region, operated by PACE Business Development Center. This webinar will be recorded, and at the end of the webinar, you'll be asked to participate on our survey. So please make sure that you complete the survey, as it's going to help us plan our future webinars in better ways. And before we learn something new today, let me do a quick introduction and PACE. Pacific Asian Consortium in Employment was established in 1976, and we are a 501c nonprofit organization. So from business, workforce, utility bill assistance, housing, and education, our five departments are equipped with the necessary services to tackle poverty and economic inequity in diverse communities across Los Angeles since 1976. So we offer one-on-one business counseling, credit and asset building, business and financial plan development, webinars and training, just like today's, to help you establish a brand new business or your existing business. We can also guide you to get into the procurement contracts through our procurement department services. And the greatest fact is that all our services are free. So if you have any questions about our services or any of the lending products, please visit our website, pacelabdc.org, for more information. All right, let's dive into our topic of the day. Edgar, please take on. Thank you.
All right. Thank you, Jeannie. Welcome, everyone. Thank you for taking out of your busy schedules to be here. You're joining the last but not the least, part 4 of our series, Hack the Bank. When the bank says no, navigating alternative and private capital. It's a gut punch when you have a solid business and you're working hard and a traditional bank turns you down. So I want to validate your frustration right now, and it's not always about you, it's about their system. So today we are going to talk about reality, and more importantly, we're going to talk about your particular options. So let's skip about my info. You've been seeing this info for the last 3 weeks. So let's go on and let's start by grounding ourselves in the reality of business lending today. A lot of people, small business owners like you, will always ask, why do banks say no? You know, is it because traditional banks have strict underwriting boxes? Yes. Most traditional banks are heavily focused on real estate lending. Yes, they seem to do. Um, most banks would want real estate transactions as opposed to just business lending. And lastly, one of the things about traditional banking is that they tend to focus on larger amounts. When I say larger amounts, you're looking at, 500,000 or more. That's their minimum threshold. So the goal today is to empower you with the right tools to grow and thrive in your business. And I want to leave you with a strategic financing direction that is realistic with your pathway to capital access. So I want you, when you leave this webinar today, you will exactly know where to look when those traditional doors close. So let's dive in our first alternative, which is short-term loans. This is usually a lump sum of a loan or revolving line of credit ranging from 3 to 24 months. These are explicitly designed to bridge your immediate cash flow gaps. The beauty of this thing here is speed. So they can approve your loan quickly, usually within, I would say, 48 hours. Compared to an SBA or a traditional business loans, the funds arrive incredibly fast, so quick. However, the trade-off, mind you, is how you pay it back. You generally look for a daily or weekly repayment via ACH straight from your business account, as opposed to a business loan where sometimes you just send a check or they auto debit your account. Here, with a short-term loan, payments are done via ACH on a weekly or daily basis. Now, let's look at pros of a short-term loan. Let's weigh this out. So speed of funding is the biggest draw for this. They are also much easier to qualify for than a bank loan. It offers a quick payout because the terms are shorter, usually 18 months or less. And you don't have to put up any collateral of some sort. It's usually available with an unsecured option. Now, the downside to it, of course, there's always a downside to this. Uh, you have to be honest with the fact that this is a costly convenience. Those frequent repayments that I mentioned, they can be brutal to your operating account. Imagine if they are deducting daily on your business account. That can be brutal. Now, they don't really take out 7 days a week. What they do is they will take out payments every or per business day, which is 5 days. Or in same manner, most short-term loan nowadays are done weekly payments. So this could pose a serious risk of falling into a debt trap if you borrow again. Before you're considering a short-term loan, I want you to look and make sure that before you sign the dotted line, you must be able to prove mathematically that the financial gain that this loan is significantly greater than the total cost of capital. If it doesn't leave profit, then don't take it. To find out, you can use the ROI formula. And I have a infographics here of a scenario where, let's walk to a sample of this. Say you're a contractor. You just won $150,000 commercial bid for an office building. And the thing is, you have to pay for your materials, equipment, and payroll. However, your clients pays you net 30 or 45 days. So what do you do, right? You have the contract, it's $150,000. But then again, you need an upfront $40,000. So getting a traditional loan is not an option because it takes time, so you have to start your project ASAP. And if you apply for a traditional loan or SBA loan, it'll take you months for that to happen. So what do? You explore a short-term loan scenario. So you take out a loan, You put it online to apply, you got approved for, let's say, $40,000. And usually the factor rate, which is it's not an interest rate. So let me clarify that. Factor rate is your uh, rate that any short-term lender use to assess the risk of giving you an advanced portion of their money. So in essence, the higher the factor rate, the higher the risk. So the lowest that I've seen out in the marketplace is 1.2. So I'm just giving you this as an example. So let's say the factor rate is 1.2. So you multiply the upfront cost by 1.2. So that yields you $48,000, right? So $48,000 minus 40,000, which is your upfront cost, will give you $8,000. So your contract value is 150,000. Let's say, just as an overhead, your overhead for labor and materials is 110,000. So your total financial gain from this example is 40,000. So your cost to borrow is 8,000, your financial gain is 40. So you run the numbers, right? So 40,000 minus 8,000 is 32,000, right? So you divide that minus cost and multiply by 100. So in which case, in this example, your ROI is 400%. So is it worth it? Yes, it is, because the investment pays for itself and adds $32,000 to your bottom line, right? So, but if it's not, if it's negative, then, a short-term loan may not be a good idea for you. And you have to be careful as well because, like I mentioned to you earlier, the aggressive repayment for these types of loans can be very uh, can affect your cash flow negatively, as far as weekly payment goes. So just be careful, and you can use this scenario and do the math for you. As long as your positive ROI, it makes sense. Although, the cost is expensive, your ROI is over a certain amount, then it's worth doing it. Now let's look at fintech lending. So these are non-bank lending institutions that operate entirely online. They don't have, marble lobbies or tellers. Instead, they use algorithms, artificial intelligence, AI, and live data to assess your credit worthiness of your business. Instead of asking for physical copies of your historical financial statements, they use API technology. So meaning they're attaching your bank accounts to their system to assess your credit worthiness. Your payment processors or your accounting softwares to analyze real-time cash flow. Is fintech right for you? Well, let's take a look. Pros would be the use of alternative real-time data rather than historical cash flow is good because, as you know, with SBA lending, I think I've covered this in the last two or three webinars where traditional lenders, particularly SBA, they look at your historical cash flow. Here with fintech lending, they use real-time data. So the ability to integrate your data into their system can help you with the loan amount that you need. It's also 100% online, which is a frictionless experience. You get instant decisions, and approval and funding happens within days, not months. Usually within 48 hours, you'll be able to get an approval. Similarly to a short-term loans, the collection of payments are automated. They are digitally deducted from your business account. And similarly with the short-term loan, payments might be a weekly or daily as well. Sometimes fintech companies, they would do monthly payments as well. Now, the downside to this is you are dealing with an algorithmic rigidity, meaning, there's no human appeal process uh, with this. It's very remotely impossible at all. There is no in-person support for follow-ups. So if you made a mistake, you just can't call or you just can't walk into their office. You have to do a series of steps or restart your screen or, reapply to get it done. Also, most important thing as well is that the cost of convenience. They are a little bit higher in APRs than the traditional bank loans. Like I mentioned, similarly to a short-term loan, they have a very aggressive payment schedule, which can strain your cash flow. Next slide. This is an example of one of the fintech lenders, Square Loan. So if you accept those credit cards, you sometimes go with Square. So, see, they say apply in minutes, no long forms, no interest, just one flat fee, and you get the money instantly. So you can just go online if you have an account with Square, and you can do so. Another one is PayPal. Same thing. Fast funds with payments that flex with your PayPal sales. So you can get up to 300,000 for repeat borrowers, 200,000, 1,000 to 200,000 with no credit check. Again, it said, if approved, loans are funded within minutes. That's the beauty about fintech lending. You can get started, you can get the capital that you need instantly. Another one is Box. It's, apply in 3 minutes or less, fast access to funds, and flexible repayment terms. Now, let's shift gears entirely here. So if the high cost and fast pace of fintech lending or short-term lending aren't for you, let's talk about CDFIs and mission-based lenders. These are organizations such as Space that exist to inject capital into the underserved market. Why do they matter? Because they help bridge the wealth gap and provide capital access to historically underserved communities. They act as a catalyst, and importantly, they offer some programs available during downturns or natural disasters. The CDFIs are usually the first responders for deploying relief funds. They use flexible, character-based underwriting, and they want to know your story basically, as opposed to your historical financial. So it's more flexible. They want to know about your story. And the good news about most of these CDFIs or mission-based lenders is the fact that they provide added value services such as technical assistance and business coaching. So it gives you some additional knowledge. Not only you will get a loan from these folks, right? You will also get some assistance that you need or business coaching that can help you get to your next level. Now, advantages to dealing with CDFIs is that, you have a much higher approval odds, and also, the thing with the loans itself, you can have lack of collateral or short time in business. You can have those kinds of information on your file with, for example, some negative payments on your credit reports and stuff like that. However, like I mentioned, they're more about your whole story. So it's giving what the right story is, and probably you have a good chance of getting approved. It's not so much on cash flow. They look at cash flow as well, but it's how you present, what's your story is. It's what's going to be. They also have favorable rate and terms. Certainly, it's way better than a short-term loan or lending from some fintech companies. And like I said earlier, they have wraparound support. Part of the approval process sometimes is helping you with coaching and some training, additional training. I mean, now, uh, what are the disadvantage or some of the drawbacks with dealing with mission-based or CDFI lenders? Because it's manual, like I said, it's your whole story, right? It's holistic underwriting, so it often involves committed reviews. So expect a longer processing time. Usually, CDFIs or mission-based lenders, they don't have a loan committee that meets every week. Sometimes they do it on a monthly basis, and some of the members of those committees are working from other companies or other banks, so they can only meet certain times. So in most cases, there's an extended time to process your loan. Another drawback is the fact that most CDFIs or mission-based lenders have geographic or demographic restriction. So lending is restricted to a specific area based on the funds of the mission. Also, downside is their loans are usually smaller loan caps, usually between $50,000 to $150,000. A good example of a CDFI or mission-based lender is PACE, because not only they provide you with the necessary capital access, they also provide you with training and business coaching. So this screen here shows you what they offer as far as loans. So they can offer you a mini micro loan, an SBA micro loan program, or a regular working capital loan that is guaranteed, contract finance assistance, a revolving line of credit, and a green loan. So the range is actually good for a CDFI lender, usually within up to 500,000 on green finance or green loan or uh, revolving line of credit as well. So it's a pretty good program to get into. The final avenue that we will discuss today is a business purpose loan secured by real estate. So this involves your residential or commercial real estate as collateral to access business capital. Because the underwriting focus is heavily on the equity and the property rather than business cash flow of your business, you can often secure quick turnarounds and closing. This business purpose loan secured by real estate, or BPL as I call it, allows you to access larger capital, especially if you have a bigger equity in your real estate, right? So you can get up to 65% of your market value or appraised value. So how they compute for that is whatever market value is multiplied by 65% minus what you owe on your first mortgage. So for instance, if your property value is about $1 million, you take 65%, which is 650,000, and let's say your mortgage is 350,000 or 300,000. So, whatever that difference will be your loan amount. So you can access more with a business purpose loan. The approval underwriting process is easier as well due to the focus on equity. So you might have bad credit or losses in your business, but you can still get approved because, like I said, the focus is on equity. Equity matters. They will usually secure this with a second trust deed or a second lien on your real estate commercial properties. The thing with the business purpose loan is the cost is a little bit higher than a traditional business loan. Also, an important consideration when you do this is that there's a risk of foreclosure in case of loan defaults, because this is a secured loan by your real estate as opposed to just a regular unsecured loan. So let me kind of recap this, and tell you that the main takeaway today from what I see is the understanding of the cost of opportunity. Alternative capital is expensive. When done right, can help your business. Make sure to do the math. The dollar cost of opportunity is important. However, if it exceeds if it exceeds the cost, or the cost itself is too expensive, then you have to seek other alternatives. We mentioned a short-term loan where you can get your funding quickly, which is good for any type of business, but you're exposing yourself to a further debt trap. So the more you get in, they will hook you in with another loan. So once you pay up, let's say, if you do a short-term loan, they will give you an initial term of 78 weeks. So after 78 weeks, they'll hook you in and say, hey, Mr. or Mrs. Business Owner, did you want more working capital? I can have it in your bank account within a matter of minutes. We can wire the funds to you. You can use it however you want it. And sometimes, you overlook the cost of doing that business because you feel that, yeah, this is easy money. However, there's an effect to that. It may drain your cash flow, especially if your business is having some collection issues. So imagine having a weekly payment as opposed to a monthly payment. And if no collections are made on a weekly basis, then you're in much trouble, as far as getting it done, making payments. So it traps you into more loans. Similarly to a fintech lender where it's all done online. So it's easy because you don't see, the paperwork that's involved. They get you $100,000. And then, once you pay it off, you get another offer from the mail or email rather, and you can, just take it without any other documentation. So be careful with that. Another thing with fintech lenders is that they will sometimes, especially if you have a Square account, they will use your Square collection to make those payments. Also with American Express, also with if you have a Visa or MasterCard collection. So rather than taking out from your business account, they will take directly from your collection of your credit card payments or your ACH payments. So in that way, they can get paid first rather than just making payments through regular ACH. So that affects your cash flow. So you have to think about that. Make sure that you have enough cash reserve to do this. Regarding business purpose loan, this works especially with having a real estate equity. If you have a good equity, make sure to take advantage of it, especially with quick funding, because it allows you to use your capital and gain more profits. But beware of the cost itself. The cost, by the way, I forgot to mention, the cost for a business purpose loan secured by real estate is usually higher. The range of rate is usually between, I would say, 10 to 15% per annum. So annually, it will cost you 15%. Usually, you pay interest-only payments. In terms can be up to 24 months. So what it means is that you make payments interest only. So it kind of helps you because you're only paying the interest, not the principal. However, at the end of the term, you would either have to pay a balloon payment or extend the loan for another term. So which means that, the 15% per annum would extend for another 12 months or 24 months. Uh, but like I said, the advantage there is if you have an opportunity, just make sure do the math, do the dollar cost of opportunity. Is your ROI greater than what you're getting on your cost? So if the answer is yes, then let's do it. Go into it. Now, if you have time working for you, right? If you're planning ahead, like I mentioned in our previous uh, topics, when you plan ahead, when you be proactive in doing this, you can get help by using those CDFI, Community Development Financial Institutions, and mission-based lenders. They can be a good resource. One, they can help you with some business coaching or technical assistance, and it all comes with a part of the loan package. You can get up to a certain amount, like I mentioned in the previous slide, where with PACE you can get up to a higher loan amount than most mission-based lenders. And the rate is not bad. The rate is almost similar to a traditional bank loan. So when you have time and you're planning way ahead of, your expenses, when you're planning ahead, and there's some, issues with, say, credit or historical performance, then mission-based lenders or CDFIs will always be a good option for you. And let's see here. I think I've covered most of it. Short-term loans, we have short-term loans, you have fintech lending, and then, mission-based lenders. So always good with mission-based lenders, especially if the time is on your side. Now, just make sure that the cost of opportunity, when you do this, make sure to look into it. It doesn't necessarily mean that you have to go in and get those loans right away. If because most of the trap that you do, I see it in the marketplace, is that you are presented an opportunity and you want to get this done. However, the cost is too much. Now, either you back down and, not take this opportunity, or you pursue, not knowing what's there for you, right? So my point being, and I hope I can convey this to you, is that there's always an opportunity for, these types of loans, being a short-term loan or a fintech type of lending. Just make sure that you are aware of the cost involved. Just make sure that you are on top of your cost, meaning your expenses are less than what you're getting. So if that's the case, it doesn't matter what loans you take, as long as you do your homework. So uh, with that, I turn back to Jeannie, or if you guys have any questions, I'll be more than happy to answer it.
Thank you, Edgar. I think we have some questions.
Okay.
Catherine mentioned that would this be like a Kabaj or similar lender for short-term loans? I think she's referring to a Vintage loan or the revolving line of credit.
Right, right.
Yeah, and she also mentioned that the owners of an Oregon restaurant borrowed 10,000 from Kabaj to replace the HVAC system. Daily payments were withdrawn from their accounts and almost killed the business.
Yes, yes, that's what I'm saying. It's more of the cost opportunity. Make sure to calculate your ROIs first before
Yes,
getting into these, because it's easy. Like I said, you can get approved within 48 hours, sometimes even just days, one day, 24-hour turnaround, and you can get that. So it's just the cost of capital. Make sure
that's right.
you're up.
And Catherine also had a question. Are the payments a set amount or is it a percentage of how much money you have that day? What happens if there isn't enough money in the account to make the payments for batch or
Right.
short terms?
So there's two types of payments with these types of loans. So one with short-term loans, your loans uh, are paid on a weekly basis. So the quickest, simplest way to calculate, the first option is you multiply your loan amount by whatever factor it. Let's say it's 1.2. So whatever that amount is, you divide that by their term, usually 52 weeks. So 52 weeks, they will set aside that specific payment. Now, with the Square payments or PayPal, it's a little bit different, or American Express. They are a percentage of your sale. So ranging from, 5 to 8 to 9, 10% of your sale, which they take out. Some companies I've seen where, especially this is for restaurants, where they will take out a daily percentage of your sale up to 12% to pay up your loan. So that could be expensive. Yeah.
Whoa, that is very expensive.
Yep.
Okay.
Yep.
All right. Catherine also had a question. What is the difference between technical assistance and small business counseling? Um,
Oh,
I think that's my area.
yes, yes.
Okay, so technical assistance, we usually talk about like expert-driven assistance. If you need assistance with a particular, tax problems, or you need a lawyer assistance, IT pro, marketing experts, and practical applications. I mean, then you need to consult with an expert in that field. We call that a technical assistance versus business counseling. We talk about providing you with a big picture for your business. I mean, when you get into a business, you need to think about what kind of business entity you need to get into, whether sole proprietor, LLC, or corporation, and developing a business plan, whether you expand your business or pivoting, or understanding your targeting market, so on and so forth. We call that business counseling. So it's a similar, but there's definitely a difference. I hope that answers that. Okay, the questions from Anthony. Do you have a list of lenders we can contact?
Yes, if you scan or the QR code, I can provide you with a list of lenders out there.
That's awesome. Do you think it's safe for us to contact them ourselves, or is it better to go through an expert like you?
If they have experience in dealing with fintech lenders or short-term lenders, they can go ahead and contact them directly. Of course, I'll be more than happy to assist them with that. I can guide them on how to navigate those things as well.
All right, awesome. And another question from Charlene. Thank you for the information. Can you provide a ballpark idea of the difference in interest rates among short-term, fintech, CDFI, and traditional loans? In my mind, if the interest rate is extraordinarily high on one or more of them, it wouldn't make sense even consider them as an option.
Right. So going back to what I was saying, the cost of opportunity. So make sure you're doing your math correctly. So it doesn't necessarily mean that a short-term loan, the rates are too high, because the way short-term lenders calculate their risk, it's not so much about the interest rate, it's a factor rate. So it's the way I put it is that how much of money would they advance you as opposed to the rate they're charging you. So let's say that the standard is 1.2 or higher. So it's not really your interest rate, because if we're comparing apples and oranges. So with a traditional bank loan or a CDFI loan from PACE, you pay an annual percentage rate, which is ranging from 8 to 12%. Whereas for a factor rate, they're charging you 1.2 or higher. So factor rate is your advance rate, whereas your interest rate is your interest rate, the cost of money that you are borrowing, where a factor rate is the cost of risk the lender is trying to give you. So it's a little bit different. So a short-term lender can charge you a factor rate of 1.2, 1.25, sometimes 1.3. So it's easier to calculate because the cost is factored into your loan amount. So if you, let's say, apply for a loan of $10,000, multiplied by 1.2 will be your total cost of your loan divided by your term. So let's say 52 weeks. So that would be your weekly payment, as opposed to a traditional bank loan where they'll charge you 8% over a period of 60 months or 3 years or whatever. So there's a big difference. Now, fintech lending are the same. However, nowadays I've been looking at it. Some fintech lenders are actually offering APR loans, meaning they're charging you rates anywhere from 12 to 18%. It's similar to a credit card. So, they're being more transparent, because it's kind of confusing when you apply for a loan. They say, well, what's my factor rate? Well, your factor rate is this. So they always will compute, oh, so my factor rate is 20% because it's 1.2. Easier, right? It sometimes makes, oh yeah, it's just 1.2, but it's not. It's the way I may seem too technical but that's how they looked at it. So Factor rate is the rate that, the borrower or the lender will charge you to use their money. The interest rate from lenders is the actual cost of borrowing that money. So now business purpose loans are interest only loans. They range from 12 to 15%, and they will secure it by a second trustee on your mortgage. I hope that answers that question.
All right. Great. Do we have any other questions? This is your chance, folks. Any other questions? No? I think we're good.
All
Yay.
right.
All right. Thank you so much, and thanks for a great webinar, Edgar.
Thank you.
Okay, folks, Pace offers valuable webinars equipped with tons of great information happening every day. So please make sure you check our website and register for more webinars. Do we have anything else, Edgar?
That's it.
That's it. All right. Thank you so much and have a great rest of the day. Thank you.
Thank you.